All righty, folks. It is Fed Day. Fed Day, Fed Day, Fed Day. Lots of stuff to talk about. We're talking with the amazing Anna Mom Kelly. Many of you look to her for all of the financial wisdom, experience, and her no-nonsense take on what's going on. So let's figure out what she will be looking for in it's about 3 hours away. So Anna, what are you expecting? What are you looking for?
Great question. We always like Fed Day. We put ourselves on the spot a little bit to, try to call it in advance. And it is really difficult to tell. But what I'll tell you that is really interesting, I think, to start with is 90% of the market believes that the Fed is going to pause now, that we're done hiking rates, that they're going to pause. And only 10% think that there's a chance that they won't. In other surveys, it's 99% of the market thinks the Fed's going to pause and only 1% thinks that they're not. Contrast that to surveys of actual economists that do this for a living, that watch the economy. And it's more like 50-50. At least 50% of the economists think that the Fed will still raise rates a quarter of a point and should, and think that the market is still being way too rose-colored glasses. And so it's interesting, the markets have been hoping for the Fed put. They've been hoping that, things are good enough that Powell's done and they say, okay, we hear you crying, uncle. We see stress in the markets. We see stress in commercial real estate, and we see stress in the banking system. So please, 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 Powell, stop. And that's what they're hoping for. And here's the thing. Powell initially said about a year and a half ago that they thought they would have to get rates restrictive, and they thought that was in the 4 to 5% range. And then last January, they came back and they were a little bit more, hawkish and said, it might be in the 5% range, or more, that we have to get rates and hold them there for some time. The sometimes really the question.
Yeah.
So that's kind of where the markets are thinking. I'm like the economists. I'm going to give it higher odds that they raise a quarter of a point than what the market is
Today.
but I
Okay.
really think it could be 50-50. If I had to lean one way or another, I think they're more likely to pause one more time and say, let's see how things are going, and leave room on the table and talk really hawkish, pause like they did in July and say, we are not done. Inflation has, come up a little bit in the last month. We're nervous about these things. We haven't gotten a hold of inflation. Oil prices are going up. That could trickle through the economy and bring inflation up a little higher. We can't, take our eyes off the ball. We're not done. And we see, maintaining rates higher for longer, but not raising rates. That may be 51% chance. In my mind, there's a 49% chance that they say, again, Powell does not want to be remembered as Arthur Burns. They do not want to pause too long and take their foot off the gas if they see inflation ticking up again. And since their last meeting, inflation has ticked up again. PPI has ticked up again, and those things could make them, I'm sure, no doubt, are making the Fed, Chair Powell and others that have voting rights this time around. I think it's making them more nervous than the doves want to make them. So that's where I stand.
That's really cool. So I'm actually 100% on the pause this time, but it to your point, it will be a hawkish pause.
Yes.
It'll be whatever above a velociraptor pause. Because also there's a couple of things in the next week that will that are acting like a rate hike. What could that be? Well, one, gas going up is a rate hike at some level, right? Because it's something that most of us pay, and we see it every week. That does act like a rate hike, and it's also the Fed can't produce oil, right? It's why it's not in core, it's in headline. Second, student loan repayments. We've already seen something in the order of $6 billion starting to be paid in September. It actually starts in October. That will act like a rate hike, right? That'll be some discretionary spending. We have strikes going on. We also have what I think could be what could come out to be the longest government shutdown in history, which I think today is 55 days. that could start October 1st. There's
Right.
all these things ahead of us, which I'm sure they see and talk about. They're like, man, we can't hike in the front of all of that. Let's give us a month, figure out what's going on in strikes, see if we're in a shutdown, see what's going on with student loans, see. I just can't imagine them hiking in front of all of that.
It's really interesting though, Michael, because they've done what we've thought they wouldn't do
True.
before. And
Yeah.
you look at what happened when the three banks failed, and essentially we had a backdoor QE to help these banks and keep other banks from failing, despite the fact that their real economic position, when you look at the value of their hold to maturity assets, if they had to sell, really put many banks into the insolvent or close category. The Fed continued to raise despite that, even though everybody says there's no way they'll do that. Because what people don't realize is the Fed has more tools to play with than just rate hikes. They've got their balance sheet, whether they're putting money into the system or taking money out of the system. So what's really interesting is this kind of battle. Don't forget that the Fed has a dual mandate, and some now say a triple mandate, right? Price stability or battling inflation, keeping maximum ideal employment is the other big one, and then of course they want GDP to be at a certain level as well. And so the Fed has basically said, and it doesn't matter what interviews you listen to, that they expect that their hiking program is going to cause pain. It's going to cause layoffs. It's going to cause a hit to consumer. It's going to cause pain in housing unaffordability. They know that it's likely to cause recession or something like it. And they're not afraid of that, because the reality is, Michael, and we're afraid of that as the American public, because we think recession's the worst possible thing that can happen. But if you look at history, the Fed almost always triggers a recession when they're done hiking rates. And it's usually within about 6 to 9 months from the time they stop hiking rates to the point that you have a recession. And so one argument to your point would be they're already seeing all of these disinflationary factors, this momentum putting pressure on the economy that could cause a recession. They don't want it to be a hard landing. So they say, okay, let's back off and let the lag effect kind of play through the system. And that's why I really give it a little more the 51% that they probably will hold. But I don't think they're as afraid to let the system have more pain as most people do. And they do not want to end up with stagflation. And I keep talking about this. You and I are some of the only people that are really talking about really the stagflation risk, more so than just more inflation or recession. But if the Fed doesn't get a hold of inflation and get it really down and really fast, it is very likely that inflation stays higher than their 2% target for a while we have slowing growth. And then they're battling this two-headed monster. We're already starting to see it. But the low growth and the inflation are just as bad, and they require different tools to get one to win and the battle to be over with the other, and then they can start to slowly kill the second one. When they're battling both at the same time, it's extremely difficult. Governments in history have not been able to tackle stagflation. And so I would argue that getting us out of a recession is the easier thing for the Fed to do if they spark a recession than not combating inflation, backing off and letting it rear its ugly head again, as it did under Burns before Volcker came. And so the Fed is not done. For those that are hoping that they're done, they're going to pause and then they're not going to do it again, and they're going to pivot quickly because they're going to have a recession. I don't agree with that. I think a recession's coming. I would bank a lot of money on it. It almost always does. And a lot of things are showing we're already maybe in a recession, which we've thought we were for a while, or we're in a rolling recession. So pain is coming. I think that the markets are too rosy, too excited that the Fed may pause. And the Fed knows that if they pause, markets rally, and it could keep inflation going even while we have slowing growth elsewhere in the economy.
Yeah, I think So again, I think there's three things that happened today. I think the first two we're in agreement, just different percentages, right? We're going to get a pause, but we're
Sure.
going to get a hawkish Powell at the press conference.
Yes.
We also get the summary of projections, right? SOP. That's going to be the most
Yes.
interesting because you're going to get, I think it's 18 or 19 opinions about inflation, GDP, terminal rate, and unemployment. I think it's going to be really interesting to see what these folks have to say for the next. I think they do it for 6 quarters. So we'll get our first look at 2025 in this
Right.
SOP. So let's start with rates. I'm going to be interested to see how many of them say they're done, they're doves, versus how many say one or more, right? Let's say there's
Right.
18 of them. Where do you think they're going to come in on that?
I think that at least right now, we're seeing that most of the voting members of the FOMC are more hawkish than they are dovish. At least they
Yep.
have been. And
Yep.
so I think, but we do have doves on the committee. And so I think you probably have, depending on the message that they want to send,
Yeah.
because here's the reality. What they say is not necessarily independent of one another. Don't think that they say, I'm going to give my vote to where I think it is, and that they're not thinking about how that voice might
Will be
impact how
messaged.
the markets view what the Fed is actually doing versus what they're saying. And I read a great book, we've talked about it a couple times on this show, called The Lords of Easy Money. And basically they talk to Honig, who used to be on the FOMC, and he was kind of this lone hawkish voice for a while that said, we cannot, continue to do QE and put all this easy money in the system because it creates asset bubbles and big market bubbles, and then it wipes people out. Hello, we should have had Honig on the board a few years ago, right? But he talks about how there's this unwritten rule that none of the Fed voting members go over the chairman. Like whatever the chairman says, they're going to say yes, and they're going to be pretty unanimous because there's consequences if they're not. And so just keep in mind the reality of some, politicizing and maneuvering and wanting to have a unified voice to the public, despite the fact that they might think something different. So if the Fed pauses, I think that the vast majority of them show that they think that that might be enough. And maybe they say possibly another quarter point if OPEC continues to cut oil prices go up, that could float into the economy, that could create some inflation a little bit longer. Maybe we'll have to raise rates a little more. And if they actually do raise rates a quarter point, I think that the majority of them say, we think we're done, but we're going to hold them restricted from some time.
Yeah, I think there's so much. I mean, this is going to be the one that's most important to me is the terminal rate, right? So
Yeah.
let's say there's 18 voting members. I'm going to guess 6 or less say we're done, like now. And that means 12 or more will say 1 or more. The other
I
thing I'll
tend
be
to agree
interested.
with that.
Yeah. So the other thing I'll be looking at is how many of them say there will be 2 or more hikes. I think there will only be 3 or 4 of them. Right. So it'll be kind of a bell curve all around, kind of, one more hike. And again, it'll be the, Powell's comments at the presser where we stand
Sure.
ready, data dependent, blah, 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 blah.
Right. I
But
think that number is low. I agree with that. I don't think that they're going to come out and say 2, because the reality is they may already be hiking into a recession.
then the next question I'll be looking at, still on the terminal rate, is how many of them have a rate cut next year? My guess is none of them have a rate cut in the first half. Some may in Q3. I think most will be Q4 of next year. I'm going to think most of them have a rate cut in Q4. That's just my guess.
Yeah, I'm going to say either late Q4 of next year as well, or into 2025. I don't think you're going to have many. If they gave an indication that
Ooh,
they
yeah.
thought they may pivot in the
That's a good
next
point.
year,
That's a good point.
the markets are going to go wild. They're going to go, they told us what they're going to do,
Yeah,
and they're
the
going to
playbook.
cut rates. And everyone's going to go, let's just hold on to the pivot and everything will be fine. And there will be a rally like you haven't seen in a while.
You're right.
Not just in the top, few S&P 500 companies that are keeping, the market somewhat up, despite the fact that most of them are down pretty significantly at this point. So
Yeah.
again, the Fed understands that whatever they project and predict paints as much of a picture as what they actually do today, and that the market is just looking for any indication that they're ready to pivot, that Fed put that we talk about, in order to pounce. And if they do, the Fed is going to have a harder time because it will spark some more inflation. With excitement, consumers will think, okay, it's almost done. Let's go,
Yeah.
book
We
that
can hold on.
expensive
Yeah.
summer vacation. We can hold on. Let's rack up those credit cards a little longer. By next
You're
year,
right.
everything's going to be okay. They're not going to do that because
You're right.
it will completely counteract any action that they take or any other language that's dovish. So again, regardless of what they think, I don't think they're going to tell us what they think. I think that they're going
Yeah.
to tend to show data that is more hawkish than dovish, even if they start to get a little more comfortable that their work might almost be done.
Yeah. I stand corrected. I agree with you 100%. I've already changed my opinion. See how good you are? So now let's
Ah,
talk about, I don't do that very often, but I
well,
did.
don't pat me on the back yet because we'll see
Ah,
what happens. But
we'll see
that's
what
my guess.
How about unemployment? That's the next one I think about. Like, well, I think all of them will have unemployment heading above 4%. I think that's just kind of the trajectory we're on. But will any of them have the guts to put a 5 handle on expected unemployment? That's the thing I'm looking for.
I doubt it.
Me
I
too. I
doubt that
doubt
they
it.
would go for the 5 because again, they've been somewhat couched and hidden, although they've been very clear. We're not done. We're in this. Inflation's enemy number one. They've been very soft in the way they've explained causing some pain for the American economy, right? Housing is going to have to come back to more equal levels, and that will cause some pain. Employment and wages have to come back down to make things a little more affordable, and that will cause some pain. So they're basically saying we are going to cause an increase in unemployment and we're going to try to bring wages down, especially in the services sector, in order to create enough of a softening to naturally bring down a lot of the inflation, in addition to what the rate hikes are doing. And so they need more unemployment in order to stop this, really voracious consumer that's continuing to spend despite the fact that they have, massive credit card debt and not a lot of savings. They're still spending like, it's at the peak or in an expansion rather than pulling back. And so they're going to create pain. And I think they want us to know that more pain is coming so that they save face if there's not a soft landing too. Because I
Yeah.
was quite frankly surprised that they came out after July and said, we don't expect a recession. We think
Yeah.
that there's going to be a soft landing. I'm like, they're shooting themselves in the foot
Yeah.
because
Why? Yeah. Why? Yeah.
almost always after they finish
Yeah.
a hiking campaign, there is a recession. Average is somewhere in the 6 to 9 month range, although there's some outliers there.
Yeah.
They know they're going to spark a recession. They're trying to spark a recession to clean things out. But
Yeah.
yet part of them saying, we don't think there is one. So I think that if they came out and said unemployment will get to 5, it kind of makes them look like, double-minded when they just said they're going to have a soft landing. So I
Yeah.
think they come up in the 4% range because I think if I'm not mistaken, last month we were at 3.8% at the end of the month.
Yeah.
So we're on the
3.8,
path to
3.7.
4.
Yeah. Yeah. We're going to
Sure.
4. And then the last one is just that GDP, right? Well, any of them have the guts to put a negative number on any quarters next year. And again, I think they're going to be doing, hey, you know, positive growth, but below trend. That's what I think
Sure.
they're going to be forecasting. So I don't see any negative numbers. How about you?
I agree with you because again, back to the last point that we made, they're claiming that we're not going to have a recession, that the American consumer is strong, the American economy is strong. We've weathered the rate increases so far, and they're going to pull off, that miraculous soft landing. So if they showed anything more negative than that, it would kind of, contradict what they're trying to say they're going to achieve. So I think they come off with numbers that are more positive, although maybe barely high, barely above what they have
Yeah.
predicted before.
Yeah.
Maybe flat a few of them.
Well, there we go, folks. It is Fed Day. That's what we're thinking. Let us know in the comments below what you thought, what you think. And of course, you want to come back after they release, you can tell us how we did. That'd be very cool. Anna, where can people find you?
Great. You can find me here. You can find me social media, Anna Kelly, REI Mom, and my new website at annakellyinvesting.com.
Ooh, I like it. AnnaKellyInvesting.com. Nice.
Thank you.